everybody. Welcome to today's fundamentals. Hello, Pedro.
Hello.
So what's up in the FX market?
Well, the euro against the dollar is moving in an upwards fashion. The pound is moving in a downwards fashion, following the release of their CPI rates. So essentially, the deal with the British pound is that the CPI rates came in lower than expected, potentially indicating easing inflation pressures on the UK economy. So essentially, the deal was that market analysts were expecting a 50 basis point hike, whereas they're slightly revising those expectations down to a 25 basis point hike, and also the terminal rate being in lower. But personally, I still think that the bank will hike by 50 basis points. Inflation is still far too high in the UK economy. Comments made by BOE members are indicating that they're still concerned about high inflation. Therefore, even if the CPI rates came in lower than expected, I think it's only temporary. So even if they do go by a 25 basis point, I do expect inflation pressures to still tick up, therefore perhaps hinting the need for further rate hikes. Therefore, based on that, I would still expect the Bank of England to continue and perhaps hike by 50 basis points instead of 25. Now, the JPY has weakened slightly. This could be a sign of slight dollar strength that I would not attribute it to that, but rather the Japanese yen potentially weakening following the BOJ Governor Ueda's comments earlier today, upon which he reiterated once again the bank's commitment to maintaining its ultra-loose monetary policy, therefore weakening the JPY and not dollar strength. Now, the dollar against the CAD is moving in a downward fashion. This could be in part of Saudi Arabia's recent comments about supporting the price of oil, in addition to China saying, reports claiming that China has stated that they're going to be supporting oil prices, therefore perhaps providing some support in the oil markets, therefore appreciating the CAD against the dollar. The Aussie against the dollar is moving in a downwards fashion. Now, the Aussie moving in a downwards fashion could be persistent fears about a slowdown in Chinese economic growth. So, as we've said yesterday and again, it appears that worries about China's economy and the desperate measures that they're taking to support their economy are making Aussie traders perhaps a little bit worried, therefore weighing on the Aussie. And the dollar against the Turkish lira is moving in an upwards fashion as expected. If I'm not mistaken, the interest rate decision is due tomorrow. But given that they've been signing deals with Saudi Arabia about energy, etc., it seems that there's no need for them to change their current monetary policy. If they're paying less for energy, therefore there's less need for them to pay immediately. That means perhaps any, I'd say, rapid or extreme change in its monetary policy could come at a later date.
And weren't also the US core retail sales released yesterday?
Yes, the core retail sales rates were released yesterday, coming in lower than expected. So traders may have been hoping that a better than expected core retail sales rate would have supported the greenback in terms of providing some breathing room for the Fed if they wanted to hike perhaps by 50, which is an extreme scenario, in their next meeting. But coming in lower has weakened that resolve. Essentially, coming in lower means that the US economy is not doing as well as was expected by market analysts. Therefore, the case for future more rate hikes is slightly diminished based upon those releases, therefore could be attributed to a slight weakening of the greenback.
And what about Canada's CPI rates that were released yesterday?
Canada's CPI rates came in lower than expected. So the CPI rates are more indicative as well of easing inflation pressures, which is why the dollar against the CAD might be moving, should have been moving in an upward trajectory, yet it appears that the recent developments in oil may have countered that effect. But overall, Canada's CPI rates coming in lower than expected should have meant that the Canadian dollar, so the loonie, would have weakened against the dollar, yet that does not seem to be the case.
And how has gold's price been reacting?
Gold's price is moving in an upwards fashion. It appears to be in a steady upward trajectory as fears of a recession and economic woes, etc., around the world are still heightened and intensifying on a day-by-day basis. It's providing some support for the price of the liquid gold.
And how about the US stock markets?
So the US stock markets is an interesting topic. So according to Reuters earlier on today, Johnson & Johnson was fined about $18 million on an account of an individual claiming that he got cancer based on Johnson & Johnson's baby powder formula, if I'm not mistaken. Now, the interesting part is that Johnson & Johnson is anticipated to release their earnings later on in this week. So despite this case not having any material impact, I would say, currently on their earnings report, it may have long-term implications if there are future developments on future court cases, etc. But for now, I do not expect it to greatly influence the stock, yet is cause for concern. Also, Ford's is lowering their prices. So, if I'm not mistaken, their F-150 Lightning pickup truck has been reduced. The price has been reduced by approximately $10,000. So they're taking a page out of Tesla's playbook last quarter, where they lowered their prices days before their earnings due to lower sales of the cars. So essentially, Ford might be trying to do the same trick. So lowering prices in order to increase demand in the long run, in order to offset any potential less than expected earnings, which are due to be released as well. So that would be interesting to watch out. We know Goldman Sachs' earnings. So Goldman Sachs is an interesting story. Many market analysts are expecting that this might be the worst quarter for Goldman Sachs in recent history. So they're essentially saying that the earnings report is going to be terrible. Now, this is yet to be seen. They might come in higher than expected, yet many are expecting that it will be lower than expected, hence potentially driving the stock price very, very low. Now, we should also note that Morgan Stanley yesterday's earnings report was better than expected. Yet, if you take the big picture, slightly better than expected, and if everyone is expecting Goldman Sachs to come in much lower, then how much lower are they going to come in? So that's an interesting story to watch out. We also know that Tesla is due to release their earnings. Personally, I think that Tesla might beat revenue and earnings per share expectations. Yesterday, if I'm not mistaken, the board of directors agreed to bring in 700 million into the company to settle an allegation that they were receiving egregious bonuses. So perhaps that might have an impact on Tesla's quarterly earnings. But what I think would have the most significant impact, would be Ford and GM using Tesla's superchargers, in addition to European companies also using their superchargers, which would provide long-term revenue. Therefore, I expect Tesla to come in better than expected. Netflix is also due to release their earnings today. So Netflix appears to have managed to curtail the bleeding from cracking down on password sharing. So by maintaining its core customer base, it appears that I would expect them to do better than expected, or at least coming in as expected on their earnings report.
And how about oil prices?
So as we said before, oil prices are moving in an upward trajectory. It appears that China's comments may be supporting the price of oil, in addition to Saudi Arabia's comments, providing long-term support for oil.
And what else is in today's calendar?
Well, we know the Eurozone's final HICP rate, where it's anticipated to come in at 5.5%. It's a final figure. We don't expect any major deviations. Using house starts numbers, which are expected to weaken the dollar. And in tomorrow's Asian session, we have Japan's total trade balance, which is anticipated to support the Japanese yen. Australia's employment data, which is anticipated to weaken the Aussie. Perhaps a reason why the Aussie is moving in a downward trajectory in anticipation of a weaker employment data as well.
Great. Thank you, Fedor, for your time. And everyone for watching. Join us after a short break for technical analysis.
Hello and welcome to today's technical analysis. So we're going to be starting off with Morgan Stanley. So yesterday, Morgan Stanley's revenues came in better than expected. So note this bullish candle which broke above R1, R2, and R3. So it's broken above two resistance levels, all three. But what is interesting and what has validated our resistance level is this 4-hour candle right about here. So the price action closed at around the $91.35 mark and then opened above, validating this as resistance turn support. So we'll be switching this up. all resistance levels will now become support levels. And we're going to be placing new support and resistance levels. So for resistance now having broken higher, this would be R1. So aiming for the $93.87 mark. Then we could R2 around here, and between the opening and closing of bullish and bearish candles at the 93.16, excuse me, 96.16 mark. And then at around the 98.05 mark. So this would be S1, excuse me, R1, R2, and R3. Placing this. We're going to be looking at Goldman Sachs, so they will be interesting. As you said, during the fundamentals, many analysts are expecting Goldman Sachs to post their worst quarter in recent history. Well, maybe not the worst quarter, but it's expected to be pretty bad. So this was going to be S3. Something we didn't mention during the fundamentals. So many of you might have heard that essentially the banks in the US would now be held to higher capital reserves. So what does that mean? Is a bank is expected to hold a certain percentage of deposits as a reserve. So in the event that a so-called bank run, upon which many individuals who have deposited their money try at the same time to withdraw the money, the bank is able to facilitate those withdrawals. Not precisely a bank run, but if there's a significant number. The problem is that a bank is not obligated to hold every single deposit, so one to one. They're only obligated to hold a certain percentage. So if too many people try at the same time to withdraw their deposits, then there's a problem, which is why Silvergate crashed. That's an issue. So essentially, they're telling them you need more money on hand, so more cash on hand, in order to facilitate withdrawals if needed. Thing is when you deposit money into a bank, the bank takes that money and then uses it to fund loans, etc., investment opportunities for them. So it's not actually there. What you're getting is somebody else's money that's already been there, and then you're refilling, etc. So if they're required to hold more money on hand, that means less available for loans, less available for any other plans, etc. So if a bank's earnings is just slightly better than expected, and then there's a problem with their balance sheet or with the loans that have already been reduced and are just barely making it by, if they have to hold more, then that might be even lower. So I expect many banks during Q3 might have an issue with their earnings, especially in terms of loans. I expect that loans will be drastically reduced in the long run based on these new requirements. And perhaps for now, going long for Goldman Sachs. Would not be surprised if price action comes down below back to S2 for a market correction before moving once again higher. Yet it's a bullish outlook for the stock, and we're going to be moving to the euro dollar. So as we said, many people had anticipated the core retail sales figure to provide some support for the greenback. As you can see, that has not happened. It appears to be moving in a slightly sideways fashion, despite breaking below our upwards moving trend line and the narrowing of the Bollinger Bands implying low market volatility. I think this is only temporary. I do expect the pair to move in an upwards direction. I think that the Fed is feeling some pressure to have a pause, quote unquote, on their aggressive rate hike path, so they remained on pause, and now I would expect them to hike by 25 basis points. Perhaps I would not expect another pause just yet, but I expect 25, maybe another 25, and then a pause. That's what I go for. 50 basis point hikes in total in two meetings, and then remaining on pause. I think they're going to be dialing it down, perhaps a softer tone, but not too soft. So perhaps saying more hikes in the future, yet we need more time to see impacts of interest rates on the market, etc. So the pound. So as you can see, inflation is high in the UK. Figures came out earlier today, indicating a reduction in inflation pressures in the economy. So instead of a 50 basis point hike, market analysts are now expecting a 25 basis point hike. So it's weakening the pound. Note how it broke below, found support now to resistance, broken slightly below S2. So we'd be bring it right around here. It needs to make a clear break below S1 at this point. 1.2930. I still believe that the bank will hike by 50 basis points. So on a technical basis, the chart is showing go short. The possibility, for going short, moving in a downward trajectory, but I think it's going to be going upwards. I think, and I'm expecting a 50 basis point hike by the Bank of England. Inflation is far too high. Not enough has been done, and they're behind on everybody else on interest rates on hiking. Therefore, based on that fundamental, I would be expecting the pound to appreciate as the bank might be hiking by 50, whereas currently market expectations are over 25 basis point hike, which is why we are watching the pair move in a downward trajectory, contradicting opinions. So R1, R2, and R3, S1, S2, S3. Technically showing in a downward trajectory, yet I expect it to move higher. Now, the dollar against the Japanese yen, a weakening of the greenback would have allowed the yen to capitalize. Now, as you can see, this is now resistance turn support. Yet I think BOJ Governor Ueda's comments may have facilitated the greenback capitalizing on a weaker Japanese yen. Not the other way around. I don't think it's a weakening of the yen, of the strengthening, of the dollar. I think it's a weakening of the Japanese yen. So moving towards R1, support and resistance, moving higher. You could even see the formation of an upwards moving trend line. Personally, though, I would be going on a more macro level. I would be bullish for the Japanese yen. They're reviewing monetary policy at the end of the year, so December, with the next meeting set for March 2024. Now, I don't expect the Bank of Japan to rapidly and drastically change monetary policy. I think it's going to be gradual, phased out, slowly, as to not upset markets too much. Yet, I do think it might be coming. But for now, we're maintaining a bullish outlook for the pair. Broken above resistance now to its support, formation of an upwards trend line, two upwards moving trend lines, aiming for R1. I do not think it will pass R1 yet. But for now, might be going an upward trajectory. Moving on, Aussie dollar broke slight sideways and moved lower, weakening of the Aussie. This would be my S3 at the 0.6575 level. And then I'd bring R1 right around here, R2 and R3. Currently moving in a downwards fashion. So this was our previous downwards moving trend line, now slightly edited to reflect the new price movement. Moving in a downward trajectory. I will be going short for the Aussie, breaking below the RSI reading of 50, implying a switch from a bullish to a bearish market sentiment. Dollar cut, but I'd like to see oil. As you can see, broke above resistance, now moving to R3, broke temporarily above R3, validating our resistance at R2 at the 74.50 level. So this is S1. And then I'd be bringing S2 at around here, 72.93. Let's just remove our support and resistance level. So this is R1. And now the question it begins to find R2 and R3. So personally, I would be placing R2 at around here. Thing is it too close? It's about $1 away. Perhaps the need for it to be slightly higher, just in case. 78.80, that would be my R2. Now you might be asking, why am I switching? Well, there are multiple places where you place resistance. Yet, I could place it here, but it's a bit too close to R1. So we're giving it some space, some breathing room, so to speak. Look at how these candles fail to break above them, then move lower, validating this as a strong resistance point. And then I'd be bringing resistance for R3 at this turning point here at the $81.28 mark. So for now, where it appears to be moving, oil appears to be moving in upwards fashion. Let's just fix our upwards moving trend line. Once again, validating our bullish outlook. So the moving from below 50 to 50 to above 50 is a potential switch from bearish to bullish market outlook. Then we could watch Google. So these are some prior support and resistance levels we have already in place for Google. So you can see it's validating S1, S2, maybe due to be slightly fixed. I'd be bringing S1 at this point, 120.20. Then perhaps S2 at the 115.95 mark. What I would keep an eye out for today is Johnson & Johnson. Their stock bound to be interesting. We'll look at the Johnson & Johnson stock in just a second. Them having to pay that fine materially may not impact their earnings. But in the long run, if more and more people make those claims, or if more and more issues or defects are found in their products, then yes, that might have a significant impact on the stock price. But before we do that, I think we should most likely look at Goldman Sachs. So our ticker is hashtag GS for Goldman Sachs. Let's find it together. So we're looking for Goldman Sachs, GM Motors. Just give me, excuse me. Let's just find Goldman Sachs real quick. There we go. Chart window. Let's just fix this ourselves. Just open a fresh one. Properties. Color scheme, black on white. Black on white is better, yes. Check this up real quick. Then candlesticks. There we go. So we could even place in our Bollinger Bands. But let's just go on a pure technical basis. Let's find this one. Note how I'm trying to line up this bullish candle with this bearish candle. This appears to be a turning point for the stock. This is where I keep S1, 335. 335, 335.19. These are just pennies. 335, big figure. So that would be S1 for me. S2 would be right below this strong bullish candle, 337, one could say. We're on the hourly. It's still valid. So, and then S3 would be at 320 point. Here actually 337.74. 317 or 318. So it appears that the stock is moving in an upwards trajectory, upwards moving trend line. Yet, what is interesting is that market analysts are expecting the earnings to come lower. So if they are correct, then I would not be surprised to see the stock price moving significantly lower. So the 42.20 is R1. R2 I would place at 349.31. So we've left about $8, yes, and then this would be R3. So this for me would be S1, S2, S3, and R1 or 2, R3. The resistance lines are a bit close to each other, but that's all right. So if the analysts are correct, then I would expect Goldman Sachs to move in lower, breaking below S1, moving towards S2, also breaking below our upwards moving trend line, and then moving towards S3. Whereas, should they be wrong, we might see break above R1, move towards R2, and then perhaps R3. And that is it for today. Thank you for watching, and until next time.
Hello, my name is Christina, and today we will talk about IronFX's VIP room. As part of IronFX's commitment to delivering educational content to support its growing trading community, we have created the VIP room. With our VIP trading room, you can access market insights, request market analysis, and ask our analysts questions in real time. The VIP room will give access to exclusive trading insights and personalized support delivered from award-winning analysts with years of experience in the Forex industry. By becoming an IronFX VIP, you will be able to benefit from interactive institutional-grade market forecasts. Each forecast comes with a dedicated discussion panel, so you can ask the analysts your questions. This brings us to our next benefit, which is the ability to communicate with our experts and ask them your questions. You can use our interactive charts to ask any questions you have on the markets. With our collaborative charts, you can watch our experts in real time and you can get clearer explanations of your analysis, where you can link the words you write with your chart objects, so everybody knows what you're referring to. Great communication means better understanding and better informed trading decisions. Our experts go above and beyond to help you shed more light on complex analysis and gain deeper knowledge on particular instruments. With the VIP room, you have the ability to request market forecasts and ask an expert to take a look at any instrument for you. If this sounds interesting, here's how to access the service. We offer 5 tailored account types and you can choose which one suits you best. The first one is the bronze, which you can access with a minimum deposit of $250. The second one is the silver, which you can access with a minimum deposit of $1,000. The third one is the gold, which you can access with a minimum deposit of $2,000. The fourth account is called platinum, and you can access by depositing at least $5,000. Finally, the diamond is available with a minimum deposit of $15,000. The Diamond provides exclusive support, which weekly calls the ability to have direct communication with prop traders and ask questions, as well as communicate with the chief trader and a lot more. If you want to gain access to our VIP trading room, simply apply for a VIP room membership and deposit the relevant minimum amount. Thank you for watching.
Ahead and get started. So today we're going to be talking about the turtle trading strategy. Before we get started, as per usual, just a risk warning as well as a disclaimer. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. The material is just the opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from or from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so I'm Melanie and I'll be your speaker for today. I'm from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, here's our agenda for today. So firstly, we're going to be talking about who exactly were the turtle traders. So some background on turtle trading strategy. What exactly was this strategy? Breaking down the strategy, how we can improve the strategy in today's day and age, and crafting your own strategy around the turtle trading strategy. Okay, so let's go ahead and get started. Okay, let's get started. So here's the history or a little bit of background around turtle trading. It is a trend-following trading methodology that was developed by Richard Dennis and William Eckhart in the 1980s. So the turtle trading strategy, also known as the turtle trading system, is a famous trend-following trading methodology developed in the 1980s. So Richard Dennis was a prominent commodities trader, while William Eckhart was a mathematical genius and trading mentor. The origins of the turtle trading strategy can be traced back to a bet between Richard Dennis and his friend William Eckhart. So they had a disagreement about whether traders could be taught or if successful trading was an innate skill. So to settle the debate, they decided to conduct an experiment by recruiting and training a group of individuals who became known as the Turtles. So Richard Dennis believed that successful trading could be taught, while Eckhart believed it was a required natural talent. So Dennis, known for his colorful personality, famously said he could teach anyone to trade successfully if they followed specific rules. So the turtle experiment was aimed to prove his point. And this actually came after saw a turtle farm. And that's hi Deepesh. Welcome to today's webinar. Let me know if you can't hear me or can't see me as well. So this actually the idea for this experiment came after a trip to Singapore where they visited a turtle farm. So that's probably the reason why they called it the turtle experiment. So in 1983, Dennis and Eckhart selected a diverse group of people, and there were actually a couple of thousand of people who applied to be part of this turtle trading experiment. So they selected a couple of people from different backgrounds with no prior trading experience, and then they began their extensive training program. So they taught the turtles a specific trading methodology, which included entry and exit rules, position sizing, and risk management techniques. The core principle behind the turtle trading strategy was trend following. The turtles were taught to identify and trade in the direction of significant market trends, where they used a combination of technical indicators, such as moving averages, to determine entry and exit points. So we'll be going through a couple of these rules and strategies later on in this webinar. So they were also trained in strict risk management rules. They were instructed to follow a position sizing methodology known as the N unit. So this approach adjusted the size of their trading positions based on the volatility of the market, limiting the risk exposure. So you can see over here, I've indicated a little graph to show you what exactly the N unit was. So N equals to the market volatility. Here we have a, I wouldn't say a graph, but it's just a brief drawing of the volatility measured across a number of days. Then we used the DMA, 20 DMA, to measure the average true range of the volatility of the market. And this is how they were trained. So after the training period, the turtles were given trading accounts that were funded by Richard Dennis. And then they applied the rules that they had learned, and then they began trading his real money. So the experiment was eventually considered a success, as the turtles collectively generated significant profits over time. So at the end of the experiment, after a year, their total profits were $175 million. So the turtle trading strategy gained widespread attention and became well known in the trading community. The rules and principles of the strategy were eventually published in a book called The Complete Turtle Trader by Michael Covell, further popularizing the methodology. So the turtle trading strategy demonstrated that with proper training and adherence to a set of rules, individuals could achieve success in the financial markets, even though they had no prior experience. So it highlighted the importance of systematic approaches, risk management, and following market trends, and it continues to influence traders and investors to this day. Okay, so what exactly was their trading strategy? So some key takeaways from this, we'll go in depth a little later on, but for their specific set of rules, their entry was to buy when the price breaks above the 20 or 55-day high or low. And then similarly, you will go in for a sell if price breaks below this specific indicator. So for stop loss, it's pretty much subjective. It's solely based on your ratio, of course, but it was based, there was no specific rule for that. And for risk management, it was 1 to 2% of your account, and vice versa for short trades. Okay, so some key takeaways after the experiment. Even though it was considered a tremendous success, market conditions are always changing, and some question whether this style of trading could survive in today's markets. So the total trading is based on purchasing a stock or contract during a breakout and quickly selling on a retracement or a price fall. So he actually turned an initial stake of less than $5,000 into more than $100 million. So let's get into the specifics of the turtle trading strategy. Firstly, we'll go through the breakout trading, which is what I mentioned earlier, one of the main features of this trading strategy. And since it's also based on a trend following pattern, we're going to be talking about that as well. Position sizing and risk management, long and short trades, as well as multiple timeframes and diversification. So those are all of the ways that the participants of the experiment were trained to use this turtle trading strategy. So firstly, let's start with breakout trading. The core principle of the turtle trading strategy is to identify and capitalize on significant market trends. Breakout trading is a popular technique used by the turtles, where they enter trades when the price breaks out of a defined range or a previous high or low. So this approach aims to capture the momentum of a new trend and ride it for maximum profit. So in this case, they use the Donchian channels, which we'll get into in a little bit. Okay, next they looked at trend following. So turtles primarily focused on trend following, which means they trade in the direction of the prevailing market trend. So they use technical indicators such as moving averages or Donchian channels to identify the direction of the trend. Traders can employ various trend following techniques to enter trades when the trend is established and exit when it shows signs of reversal. Okay. So next we have position sizing and risk management. So proper position sizing and risk management are integral parts of the turtle trading strategy. Risk management is still pretty important in today's context for any trading strategy, but we'll get into that a little later on in this presentation. So turtles use a method known as the N unit to determine the size of their positions based on the volatility of the market. That's what we mentioned earlier. So the idea is to risk a fixed percentage of their capital on each trade ensuring that no single trade significantly impacts their overall portfolio. Next, we have the long and short trades. So since they're not only limited to only taking long positions, they can also utilize short selling to profit from the declining markets. By following the same principles of trend following and breakout trading, turtles identify opportunities to go short when a downtrend is established or when the price breaks below a significant support level. Okay. So multiple timeframes. Turtles often analyze multiple timeframes to gain a broader perspective on the market. They might use a higher timeframe, such as the daily or weekly chart, to identify the overall trend, while using lower timeframes like the hourly or 15-minute chart for precise entry and exit timing. So this multi-timeframe analysis helps them to capture both the big picture trends and the shorter term opportunities. So even though in this slide we are saying that they analyzed multiple timeframes, the main time frame that they use to actually trade on is only the daily time frame. So that was a rule that was set by the originators of this experiment to only trade on the daily time frame. So as we mentioned, if you were here for our multi-time frame analysis webinar, once you've decided on a specific time frame to use, then you could use either the 4 or the 6 multiples to gain a broader perspective on the market. So for example, if you were trading on, let's say, the 4-hour time frame or 1-hour time frame, let's say, then times 4 would be either the 4-hour, or if you were looking at a higher time frame, would be 4-hour, and if you're looking at a lower time frame, would be either the 15-minute time frame. Just so that you can get a bigger perspective on both the smaller time frame as well as the larger time frames. But we always go from a top-down approach when we're looking at time frames. So we typically will look at the daily time frame first or the weekly time frame, followed by either the 1 hour or the 4-hour time frame. But in this case, the participants of this experiment only looked at the daily time frame when they were trading. Okay. Next, we have diversification. So another aspect of the turtle trading strategy is diversification. Turtles trade across different markets and instruments to spread their risk and increase their chances of finding profitable opportunities. So they may trade commodities, currencies, bonds, or other financial instruments simultaneously, depending on their expertise and market conditions. Okay, so let's break down their strategy. Earlier we mentioned that they use either a 20-day setting or a 55-day setting. And I also mentioned that they solely only used the 1-day time frame. So here I have them side by side. Here is my 20-day setting, and here's the 55-day setting. This is a Donchian channel, just to be extra clear with you guys. You can see on the 20-day setting that the Donchian channel is much closer to the price. This is used for more short-term trading, or if you are a scalper, this is the 20-day setting is recommended for scalping and short-term. Whereas the 55-day setting, you can see that there's a lot more space between the prices, and they only really measure, or rather they only really take a look at the significant swing highs and swing lows and any small movement in price. Big movement in price, sorry, not the small movements in price like all of these. Whereas if we're looking at 20-day, you can see that there are these, it pretty much follows price more closely. So for on the 55-day setting for the Donkin channel, this is more for long-term traders because it's more refined, and this is typically what we recommend as well. It's a better way to trade as well, or it's more useful compared to the 20-day setting. Okay, now let's take a look at how we can improve on that strategy. So firstly, we have moving average. MACD, even though that's the first option, we either use MACD or moving average, but I'll show you guys on TradingView in a little bit on how we can make use of both of these indicators to improve the total trading strategy. Okay, so here's the moving average that we can use from the Donkin channel. I'm just going to go ahead and open my TradingView to show you guys how exactly they used it. Okay, so over here, we're looking at Euro USD. Let me just clear my charts. Okay, so they analyzed it solely on the daily time frame, but as we mentioned earlier, they did look at the weekly time frame, so let's go ahead and look at weekly as well. Okay, so here we have the weekly time frame. You can see prices have climbed up from this swing low, but it does look like price is reversing off of this level over here. This is our weekly time frame. Okay. Okay, my mouse isn't working today, so I have to use the keypad, or rather the mouse pad on my laptop. So if you can hear that, that's the sound of the clicking. Okay. So here we have the daily time frame. You can see prices are climbing up. So I'm going to pull out our Donkin channel. So here we are using the 20 length time frame. I'm going to go ahead and remove our moving average first. So we're just solely looking at the channel for the time being. Okay, so how they trade was that, for example, over here, if price made a lower low, so for example, over here, we see price has made a lower low over here, then they will go in for a sell. That's basically the rule that they had. So from here, if price cuts below the previous low, then they will go in for a buy, for a sell, sorry. Yeah, but if we're talking about stop loss as well as take profit, loss is it was subjective. There wasn't really a set rule for that. So if you placed your stop loss over here, or rather if they placed their stop loss here, they would have gotten stopped out, right? So if we go back, let me zoom in. Okay, so we're looking just solely over here. So if, over here, sorry. So once price made this lower low, from here, it made a lower low, it cut below this area here, right? Then they went in for a sell. But if we had placed our stop loss over here, so you go in for a sell from here, you're expecting prices to drop. If they had placed their stop loss right at the entry over here, they would have gotten stopped out because price rose up before it continued to go back down. Right? So price, which is why we always recommend you to place your stop loss before any big area of confluence. And what we mean by big area of confluence, over here we have this swing low here, as well as a swing low here. So this area, okay, let me just get rid of this. So when you have this area here, this is considered an area of confluence since price has tested this area many times before. Okay, see, I can even drag it all the way back over here. Okay, price testing this area many times. So this is what we call a confluence area. So for them, once price cut through here, this specific area, which is our previous low, they're going for a sell over here. Stop loss is subjective. So if they had placed it anywhere over here, they would have gotten stopped out because you can see price reversed up over here. That's why we always say we want to place it before any major confluence area. So we'll get into risk management a little later in this presentation, but I just wanted to point that out since we're looking at a chart now. Okay, so then they would have gone in for a sell and they wouldn't know because these people don't have prior experience. So they would have gone in for a sell, just wait for price to drop all the way until here. So this could be our stop, our take profit over here. So that's basically how they traded. It's using the Donchian channel. Basically, when price keeps making a lower low, then they just go in for a buy or a sell. So maybe another example that we can have over here would be at this take profit, where price made a lower low over here. The minute it cuts through here, they were going for a sell. But you can see price reversed all the way until here. Right? And once again, this is a significant level because price has tested this. We have tools a confluence area. So if they had placed their stop loss over here, they would have gotten stopped out. So we always recommend place it before your confluence area, and then you can see it go down, then they will have made a profit over here. Okay, so that's basically how they use just channel. So now let's take out let's add, okay, let's also change this to 55. So this is why we say that using the 55 would be better, because previously on the 22, okay, let's change it back. You can see on the 20, it's following price very closely. So it's a little bit difficult to see if price made any lows. Whereas when we have our 55, you can see really clearly. You can see from here to here, for example, where I pointed out earlier, it's very clear that price made a low, another low after this previous low, even without my support level. So here, one look, you can see exactly where price has made a lower low, and then that's where they will go in for a sell. So that's just the Donchian channel alone. Let's add the moving average. Okay, so similarly, as we mentioned earlier, they would go in for, they're looking out for breakouts. So an example of this would be over here, for example, price is moving below the moving average, but then once it comes up above here, above the moving average, they were going for a buy. Which of course you can see that it did drop, which is why we say again, depending on where the stop loss is, if it was here, it would have been fine. But if it was exactly at the swing low, they would have gotten stopped out before price reversed. Because you can see price did reverse here, and then it went back up, and they would have made this much of a profit. So it's not the best trading strategy, of course. Now that we are in modern day and we know some other trading strategies, but this is basically what they did. A very simple set of rules to follow, which actually resulted in them making a big amount of profit in the span of 1 year. And the thing is that they couldn't miss out on these breakouts as well, because since they're trading on the daily, they only have 365 days minus the weekends to trade as opportunities for them to trade in the experiment. Okay, so whenever they saw a breakout like this, they had to go in for it. Okay, I think another thing that helped as well was that maybe because the financing wasn't exactly their money, so they didn't have the issue of emotions that most traders face, since most traders would be trading with their own money. Yeah, but the money wasn't theirs, and they also had the confidence of an experienced trader backing them up, telling them that this strategy was going to benefit them. So since they didn't really have any emotions as well as insecurities that were tied to this trade, it was probably easier for them to trade as well. Okay, so that's basically the gist of what happened or how they used to trade. So let's get back into another way that they use this trading strategy. So after using the Donchian channel, they also made use of stochastic. So let's go ahead and look at that. Stochastic is a let me just change this. Okay, it's fine. It's an indicator that we like to use as well, because it shows us the momentum of price as well. So typically in today's day and age, how we use stochastic is by looking at trend breakouts. It's by looking at divergences as well. If you were here for our stochastic webinar, you would know that. So similarly, how they used it as well in combination with the Donchian channel is by simply looking at whether it's overbought or oversold. So you can see over here it's oversold, right? So then they were going for a buy. That's basically how they used stochastic. So they didn't look at divergences at hidden resistance and support levels like we do today. They just looked at if it's overbought, then they were going for a sell. If it's oversold, then they were going for a buy. That's what they did back then. Okay. Okay, let me know in the chat if you guys have any questions as well. We're just going through what exactly they did and how exactly we can improve on it with our hindsight, now that we know better. Okay, so now let's talk a little bit about trade management, which I mentioned a little bit earlier on. So why is trade management so important? So firstly, it's to control risk. So by having trade management strategies such as stop loss orders and position sizing, it helps traders to limit their potential losses and manage their overall risk exposure. So earlier on, I was talking about how where exactly is a good idea to place your stop loss. In terms of position sizing in the context of the experiment, they actually position sizing, they only placed 1 to 2% of their total capital. So the total capital that the original creators financed for them, they were only allowed to use 1 to 2% per trade. So that helped in terms of position sizing. Stop loss was completely subjective and completely up to them. So in today's context, when you are trading with your own money, position sizing, it's again up to you in terms of your capital and your risk appetite. But leverage and margin would help a lot as well in terms of what lot size and what position sizing you would want to use. Okay, secondly would be to maximize profits. Trade management strategies such as take profit orders and trailing stop loss would help traders to lock in their profits and maximize their returns. Third would be to manage your emotions. So as I mentioned earlier, these participants weren't exactly trading with their own money. So perhaps this wouldn't have applied to them. But for us as normal traders, the discipline and structure that trade management provides can help us to stay calm and rational, even in volatile markets, which can prevent impulsive decisions driven by fear or greed. Okay, number 4, to improve trade efficiency. So if you have a well-defined trade management plan, traders can make faster, more informed decisions and avoid the cost and time of having to constantly monitor and adjust your positions. And lastly is to increase consistency. So effective trade management rather, can help traders to achieve consistent results over time by reducing the impact of individual losses and maximize the impact of winning trades. So in summary, trade management is important regardless of what trading strategy you use. If you're interested in looking in using the total trading strategy, it's important to implement your own trade management as well. Okay, so right now let's take a look at some trade management strategies that you can implement together with total trading strategy as well. So earlier on, I was talking a bit about confluence. Over here in the slide, we're talking about Fibonacci confluence, but as I mentioned when we were looking at the chart, it's confluence pretty much for anything. So if you have a couple of swing highs that lie in the same area, that's a pretty strong level. And if you combine that together with, let's say, a Donchian channel or a pivot point indicator, and all of those levels line up, that's a confluence area as well. So it doesn't only have to be for Fibonacci. But in this case, we're talking about, in this slide, it's talking about Fibonacci. Okay, so stop loss, earlier I was mentioning that you place your stop loss beyond a key confluence area. Why? Because price is attracted to strong areas of confluence. So earlier on, I showed you that if you placed your stop loss right before a area of confluence, then you'll get stopped out. So similarly, if your stop loss is right before instead of beyond it, you'll likely get stopped out before the market reverses, which is what I showed you guys in the chart. So take profit, on the other hand, we want to place it before a key confluence area. And why? Because when price reaches the confluence area, there's a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry, or even worse, to your stop loss. So this is also one of the reasons why people complain that the market is being manipulated, because they miss their take profit by 1 pip. Okay, so here's just a diagram to show you the proper stop loss and take profit placement. So this applies for really any kind of trading strategy. So the proper stop loss and take profit placement ensures that you maximize your wins and minimize your losses. So, for example, in this example over here, I showed you guys this red area is our confluence area, and that's where we place our stop loss beyond it. So over here, you see similarly major resistance area, which can be considered as our confluence area. Stop loss, we'll place it beyond so that we don't get stopped out. Similarly, for take profit, we want to place it before a major confluence area so that there's a higher chance that price will hit our take profit before reversing off. So let's see if we can find any potential take profit areas. Okay, so for example, over here, okay, if I had placed my, okay, let's say, here, okay, this is my area of confluence, and I'm expecting price to go back up here, right? Because as we mentioned earlier, the participants, once price breaks out of our moving average, they will go in for a buy, right? But then we can see after they go in for a buy, it drops down. So in the same way that we would place our stop loss after here, just in case price reverses off, which it did, once it goes back up, where will we place our take profit? So since stop loss, we place it above. If we place it over here for our take profit, it would have missed our take profit before reversing back down, right? So we would place our take profit before. And you can see that the candle wicks just nice touch our take profit. Okay, and that's why it's so important for you to place your take profit before a confluence area. Okay, let me know if you have any questions, but we're just going to go through some risk management techniques. Okay, so here we have break even. So I'm just going to briefly go through these trade management techniques, but we go through them in depth in our upcoming trade management series, so keep an eye out for that. But here's just a brief run through that you can use in combination with the turtle trading strategy. Okay, so break even. Break even is a level where you are in profit and recognize that there's a risk of a reversal, which basically means that price is going to hit back to your entry. So it is basically saying if I am right, price should go all the way back to my target, but if I'm wrong, I should get out. Okay, so let's take a look at the diagram here. Here we have our entry firstly, which is the blue dotted line. Buy entry on breakout, hoping for price to push to our take profit. So the gray highlighted area here is a double swing high resistance. And you can see price has broken out of this resistance. So we're expecting it to continue to rise. We're expecting to continue to rise and head towards our take profit. And our take profit is over here at this green area. Okay. But you can see our original stop loss is way down below here. Even after, or rather beyond, as we mentioned earlier, it's beyond this swing low over here. Okay, so between the blue and the yellow dotted lines, price is trending, it's moving upwards, right? And then it goes up above this this level here, and we're expecting it to hit our take profit, but we can see that it reversed right over here. So if we're not entirely sure whether price is going to hit our take profit, that's where we add our break even, which is at our, or rather, it doesn't have to be a swing high, but it just has to be at a level that's in between your take profit and your entry. Okay, so to minimize losses even more, we changed our stop loss. So we placed our stop loss at our break even, or rather at our entry, which is over here. We place our entry to protect our position. So if price continues to rise, it's a good thing, of course, but if it reverses, we want to be protected and to get out as soon as possible. So we got out of this losing trade at break even. So we got out over here because you see price definitely reversed off and we got stopped out here. So if we had left our stop loss over here, we would have lost a lot more money. Okay, next we have idea invalidation. So idea invalidation is usually placed before your stop loss. Is the level which you basically admit I'm wrong, let me get out. So when this level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. So let's look at the diagram here once again. Your entry, same thing is over here. We're expecting price to drop all the way down to our take profit over here. Okay, so it's going down nicely, and then over here it reverses and it heads back up. So once it hits our entry, then we realize that we're wrong, and then that's where we place our take profit to our entry. So that gets us out of our losing trade. So you can see once we've realized that we're wrong, we place our take profit at our entry, and then we get out of the trade at break even before price rises further and would have stopped us out. So this is two ways in which you can minimize your losses. Okay. Okay. Here we have different methods of trading stop loss. So this is another way to minimize your losses is by having a trading stop loss. So there are many different methods. So I'm not going to get in depth. I'm just going to briefly mention a few. So here we have moving average, which is the first one, followed by parabolic star, chandelier, and ATR indicator. And then over here, we have the support and resistance levels and a combination of these methods. Okay. So these are really important when you are using any kind of trading strategy. Doesn't even have to be a turtle trading strategy, but since we mentioned earlier, by looking at the turtle trading strategy, where exactly are good places to place your stop loss as well as your take profit to maximize your returns and minimize your losses, I figured we just add this in as well. Okay, that brings us to the end of our webinar. Let me know if you guys have any other questions, but thank you guys so much for coming to our webinar today. Hope you guys found it helpful, and I will see you guys next week. Bye! Feel free to let me know in the chat if you have any questions as well. Okay, seems like there are no questions, which is great. So, yep, I will see you guys next week. Have a great rest of your week and see you guys soon. Bye!